Hi, my name is James Baldwin, and this is another of our podcasts from the Johannesburg Stock Exchange on trading derivative instruments. This particular podcast is a brief introduction to option trading strategies. And this is a topic quite on our mind at the moment because we've just completed our poster. We'd quite like you to sort of have a look at this poster. We've got some copies of it, and it's available on our website under SAFEX Style Options Strategies, on a link on the right-hand side. Our website is jse.co.za/options. So we'd like you to have a copy of this. If you'd like a physical copy, we could post it to your classroom, your lecture room, or to your trading office, or just to you personally. Please email us at options@jse.co.za, and we'd be happy to post you a copy. Now, that poster is really probably the best place to start your introduction to option trading strategies. If we look at sort of the slide I've got here, we can see the option strategy spectrum. Now, this is a very interesting way of looking at sort of option strategies. We come back once again to our normal distribution. So we can see the bell curve here, and on the left-hand side, we've got very bearish markets. The far left is extremely bearish. Now, the most obvious thing to do there is just buy a single put. So you're just going to have the right to sell something to someone at a future date at a guaranteed price now. So, for example, a stock trading at 100 Rand, you can buy a put to sell it at 100 Rand at some point in the future. The idea being that it will then have fallen significantly, let's say to 60 Rand, and you can sell it to someone for 100 Rand because you bought that option to do that. Then on the far right-hand side of the slide, we can see that you buy a call option. So if something's going to rocket upwards, the most simple thing is to buy a call. Let's say it's trading at 100 Rand now, and it could be at 150 Rand, but we still have the right, but not the obligation to buy it at 150 Rand. Then the interesting part where option strategies really come in is for the middle. Now, the bulk of the time, as the normal distribution shows with the height of the distribution, is the middle. It's neither very strongly bearish or strongly bullish. It's somewhere between the two. So you've got a whole bunch of strategies you can do there. You can write straddles or combinations. You can buy bear spreads or bull spreads. You can combine various different option and stock or future positions to create a unique sort of payoff regardless of market conditions. You can structure a strategy that can profit in any market conditions. For times when the market's doing very, very little, you're going to try and profit from writing options and getting that premium in. Although this is generally a better idea for more advanced users who've watched a lot of education and have traded options before. We certainly wouldn't recommend, as a brand new novice coming into our market, trying to sort of write naked options. It's not a great idea. Then if we look at the next slide, we've got a fantastic diagram, which is reading a profit diagram. It shows multiple things. On the x-axis, we've got the stock price at expiration. So this is your price at expiry for a European option, going from left to right. So at 0 on the far left and moving out on the right. And then on the y-axis, we've got profit or loss going up or down, with the 0 being your 0 line where you start to break even. So that line where that crosses, where our strategy line crosses, that's the BEP, the break-even point. Then we've also got K, which shows the strike price. So on the slide, we've also got risk, and this indicates how much loss the trader can experience if the market moves against the strategy you're trying to do. It's generally described as limited or unlimited. The example would be for a put. If you'd sold a put, the stock could collapse down to 0. But the most you could lose is, let's say the strike price was 80 Rand. The most you could be on the hook for was to buy a stock for 80 Rand that was currently on the verge of bankruptcy, trading at 0. So that would mean that you could lose 80. So in that case, the risk is limited, but it's incredibly significant. With a call, it's theoretically unlimited, the loss you could make if you wrote a naked call. The stock could go from 1 Rand to 500 Rand for some unforeseen event in the future. So your loss on writing a naked call is theoretically unlimited. It's generally sort of significant that it's limited or unlimited. So the reward shows you how much profit you can experience if the market moves, favor your strategy. And your break-even point is just where you cross the line of having just covered your premium. So now let's look at this put, the long put slide we've got here. we've got a profit or loss diagram, and we can see with strike K, let's say we've got a stock trading at 100 Rand, and we buy a put on it at 90, so our strike is strike K, and we pay 10 Rand for it. Now we've paid 10 Rand for that option, so our break-even point is going to be our strike price less that 10 Rand we paid for the option. So we've got a 90 Rand strike price, we've paid 10 Rand, our break-even point, we're going to start making money once the stock goes beneath 80 Rand. So this is very important to acknowledge where your actual price difference is, where you're actually going to start making money is your break-even point. So when you're very bearish, this is the most simple strategy to do, is your long put, where you just buy some protection on a stock you don't own and hope to buy it back cheaper at a point in the future. Now, unlike shorting from buying a put, if the stock keeps going up, your loss is capped. We can see this from the line going across to the right. That just shows the loss is capped. The most we can lose is our premium of 10 Rand. Now, the next slide shows a long call. A long call is a very bullish strategy. So we would buy a stock, and if we were willing to buy a stock, we should possibly think about being willing to buy a call. The reason for this is the leverage. We've got this inverse leverage where we've got limited downside and unlimited upside. You can see this line increasing up to the right, and the stock could increase massively. Over time, generally stocks have gone up, so buying a call in a bullish rally can be a very, very profitable situation. Because of this leverage, on sort of a 10% move, sometimes you can make as much as a 30% profit. So it's very, very useful to consider the leverage when making an investment. So this is your most sort of bullish strategy, is your long call. Our next picture is a long straddle. Now this is basically a bet on a market that is going to move significantly in either direction. Generally, it'll be something very significant. One of the times you can trade a straddle is if there's a very significant piece of corporate news. If a company is in front of the Competition Commission and they're about to pay a significant fine or not have to pay a fine, and you think that's going to make their stock price move significantly, you would consider buying a long straddle. How do we construct this? Basically, you buy a call and a put at the same strike price for the same expiry. So if the stock price was 50 Rand, we'd buy a put at 50 Rand and a call at 50 Rand. Now we're going to be paying two sets of premiums. So this is a very expensive strategy because we're paying these two sets of premiums. So it's 5 Rand each, so we paid 10 Rand. So now for us to make money on this strategy, we need the stock price to move either below 40 Rand or above 60 Rand. So we need a very significant move. What we are betting on here is volatility. We are betting that volatility will kick in and the market will move very significantly before our option expires. The person who's writing us the option thinks nothing much is going to happen with the stock price, and we will have paid across a premium before the volatility kicks in and we are able to profit from that situation. So it's sort of a news-dependent situation. The other time that it's great to use a long straddle is sort of at the cresting top of a big sort of bubble market. When you think things are starting to get very, very overvalued, putting on a straddle can be a very, very profitable strategy. For example, resources prices were going absolutely nuts in sort of middle of 2008 with oil at $150 a barrel. So resources were in quite a significant bubble, and we had very, very overvalued companies in some sectors, according to some people, and they were waiting for the market to collapse. The problem is, in these sort of bubble conditions, the market can keep racing up for quite a bit longer than you thought. In this situation, the straddle is good because you'll keep profiting from the call side as the market keeps running up. And when the eventual collapse happens, if you've still got your straddle on, you'll be able to profit significantly from the put side. Then on to our next slide, which is the payoff diagram for a long strangle. A long strangle is similar to a long straddle, but your strikes are further apart. And because of this, you have a lower price. You end up paying a lower premium, but your boundaries are wider. So for example, if we had a stock trading at 100 Rand, we would maybe buy a put at 90 Rand and a call at 110. Now those two together would give us a similar dynamic to the straddle, but we'd pay quite a lot less money because they were significantly out the money when we bought them. So our put and our call would be out the money, they'd be cheaper, and our strategy would be a bit less costly. So it's sort of maybe a lower conviction move than a long straddle, and it would be a little bit cheaper to do, but it would be just as hard or take just as much of a big market move for us to make money from it. Now, another very popular strategy in the options market is the bear put spread. So let's have a look at this bear put spread slide. Now, what you do is you will buy a put at a higher strike and sell another put at a lower strike. So to pay for our immediate put that we think the stock price is going down, we will sell another put further out the money because we don't think it'll collapse quite that far. So even if it does, we'll then lock in the difference between the two premiums. So if we buy a put at 50 Rand on a 50 Rand stock, we will sell another put at 40 Rand because we think the price is going to go to 41 Rand, 42 Rand. And by selling the put at 40 Rand, we're going to largely defray the cost of having bought the put at the 50 Rand higher strike. So this is sort of in an intermediate market where you think there's going to be a bit of a move down, but not a massively significant move down. Then putting on a bear put spread could be a very, very good strategy to do. Similarly, in a mildly bullish market, we've got a strategy called a bull call spread, where you would buy a call option at 105% and sell one at 115%. By selling the 115% call, you've locked in a sort of difference between the two prices. You've capped your maximum gain, but you've also capped your loss and made that potential loss in the event nothing happens significantly lower because you've bought your option and you've sold another option to reduce the cost of that position. So it's a nicely risk-limited structure for a limited price where you can make quite a significant return with a limited risk. Now, if we look at the next slide, we've got a hedging strategy, which is the famous long collar. This is also sometimes called a zero-cost collar, where we lock in a certain return by selling a call on stock we've bought and we buy a put. So we get these two costs to offset, and that's the name of the zero cost comes in from that the call that we sold and the put that we bought, their costs match, and because of that, we don't have to put in any premium whatsoever. And we've managed to keep a protected, limited range in which our stock can already go. A good idea would be to put on a long collar once you've already got quite significant returns in a stock or a futures position you already have. You don't want to exit it just yet, but you just want to lock in those returns in advance whilst holding on to that underlying position you've already got. So that would be the long collar. Now, another strategy is the fence. Now, on this next slide, we've got a long fence. And we can see we already own a futures contract or asset. We've already made quite significant profits. And generally, this will be with something sort of fundamental analysis as well. You would say, I bought the stock at about 70 Rand. It's now gone up to about 110 Rand. And I'm very happy with it at 110 Rand. I'm starting to think it's quite an expensive value. But if you were an asset manager, you have to be largely invested in the market at all times. But you would be quite worried about losing those returns if the market were to collapse. So what you could do is you could put on this structure called the long fence. So what you would do is you buy an at-the-money put, which is a 100% put. You would sell an 80% put, and you would sell a call that's out the money at 120%. Now what this does is, in effect, you've got a zero-cost collar. You can get it quite close to zero cost, and you've also locked in a bigger potential upside, because with a collar you'd probably have to put your strike at something like 105%. With the long fence you can put your strike at 120%, so you've got another bit of upside. A key part of it is you have to be happy to write that put at the 80 Rand strike. Now at the 80 Rand strike, as an asset manager, you're going to receive 100 Rand for the stock you sell, then you're going to have to buy it back at a price at 80 Rand. So you've locked in that 20 Rand profit. So you're only really upset if it goes beneath 60 Rand, which you think is very, very unlikely because you've locked in that 20 Rand profit. You're also got a fundamental value overlay where at 80 Rand you start to think, hang on, this stock is actually quite a good deal. I'd get back into that stock at 80 Rand because long term my forecasts say this stock will go up above 100 Rand. So you lock it in when you're sort of nervous, you've made your profits already, you don't want to divest of your assets because, especially as an asset manager, you have to remain fully invested. So it's a very unique South African trade, and it's very, very popular in our market. We see a lot of fences going through in the South African options market. So we can see from these brief strategies, please do have a look at our poster. There are quite a few more strategies. We've also got a little booklet out on option strategies, which is also available on our website. And we hope that looking at these few brief option strategies gives you some insight into some of the amazing ways you can make a profitable portfolio in any sort of market conditions using combinations and option trading strategies. We hope you enjoyed this podcast. Thank you.